Check. Yes. Are you able to hear my voice now? Yeah. Okay. Yeah. Sorry for the delay. Technology, right? Bluetooth speaker in some other room, and my computer gets connected to that thing. Yep. Welcome once again. Welcome everybody. Sorry for having you wait for 5 minutes. This crucial 5 minutes. Yeah. So we'll quickly start up. Anything important or any doubt you have in Group 2 standards, and let me tell you, Group 2 accounting standards have a lot of concepts involved in them. Group 1 are pretty simpler. Group 2 have lots and lots of concepts involved in them. If you have any difficulty in any specific concept, do put it out in the chat box. We'll try to cover that, right? And let's start off. I'll be sharing my screen. Yeah. I hope you're able to see my screen as well. So let's quickly start off. So as far as accounting standards are concerned, right? We have accounting standard 4, accounting standard 5, you have 7, right? Then you have accounting standard 9. A lot more theory involved. Very few questions can be tested on practical or numerical basis. A lot of these standards have theory. Right? As you move towards the other part, like AS 19, AS 17, where or earnings per share, deferred taxation, there some numericals can be tested, but largely these standards have lots and lots of theories. So starting off with accounting standard 4. Now the crux of the standard for your exam purpose, and please note this is a revision lecture, this is not a full-fledged lecture. Accounting standard 4 deals with contingencies and events occurring after the balance sheet date. Okay. Now as far as contingencies are concerned, accounting standard 29 deals with contingent liability. So a lot of things which were earlier dealt by AS4 are now covered under AS29, provisions and contingent liabilities. What is covered in AS4 as a part of contingency is only contingent losses, like provision for bad debts. So provision for bad debts arises out of a contingency. Such things are covered here. And we obviously have coverage of events occurring after the balance sheet date, right? Now, what are contingencies? Contingencies are uncertain events, right? Now, the event may happen, the event may not happen. Based on that, we may have a loss, we may have a gain. Both the scenarios are possible. So, say for example, there is a debtor, and the debtor owes us some money, and there is a the debtor is not doing good. He is in financial crunch. So, there is a contingency that the debtor will not pay us the amount. And when there is this kind of contingency, there may be a contingent loss, because of which we create something called as provision for bad debt, right? Now, don't get confused. This provision is not provision as per AS 29. This is just an allowance for bad debt. That is as far as contingency is concerned. Don't need to break your head more than that in this case. The other aspect is events occurring after the balance sheet date, right? Now, what is this event occurring after the balance sheet date? Just a second. This session will last for about 1.5 hours, and you will be able to access it later also. But if you are live, then you'll be able to interact and ask immediate questions, if any. Okay. So what is this event occurring after balance sheet date? Let me open one Excel. So this is something which I wanted to share with you quickly. I could not, the audio disturbances and all of those things. This is one thing where we can see the weightage of marks, and we have only considered after July 21 because AS4, AS5, AS22, AS17, these were moved from group 1 to group 2, and now you can see every attempt 30 marks of questions are being tested from accounting standards. This is what you can secure if you are fully confident with accounting standards. Compulsory question 20 marks, and at least 2 to 3 questions in the last question, that is question number 6. Okay. Now coming to contingencies and events occurring after the balance sheet date. What are these events occurring after the balance sheet date? So there is a balance sheet date. In our case, mostly it will be 31st of March, let us say 21. Any event occurring after this date, 1st April onwards, till the time the financial statements have been approved by the approving authorities, what all events happen? Those are events occurring after balance sheet date. So let us say board of directors, they approved on 15th of April, maybe slightly early, maybe let us say 31st of May. Okay. Now, events occurring between 31st of March, that is on 1st of April, on or after 1st of April till 31st of May, what all events are occurring, those events are called subsequent events. Those events are called subsequent events. Now, as far as your standard on auditing is concerned, there you have to consider your audit report. But here, only till the time they have been approved by the approving authority, mostly board of directors in case of companies. Okay. Now, so these are the events that occur between the balance sheet date and the date on which the financial statements are approved by the approving authority, board of directors or approving authority. Very important for you to remember this definition, this specific definition, because whenever a question is tested from accounting standard 4, you are expected to write this particular definition. Okay. Now, all of you might be aware that, or all of you would have learned that all the events which occur after the balance sheet date can be categorized into two parts: adjusting, non-adjusting. And you would have learned sufficient examples. But what happens is in examination, sometimes you tend to get confused, and most of the students, they do not write the definition and they do not tell what is to be done if it is an adjusting event, what is to be done if it is a non-adjusting event, right? So again, when you're writing the paper, define what is a subsequent event, explain adjusting and non-adjusting, and then give your conclusion accordingly, because here you will get mostly a theory question. Even if it is a numerical question, that will be revolving around theory only, right? Now, adjusting event, the name itself suggests these have to be adjusted in this particular balance sheet or financial statements. So when I say adjusting event, these events are adjusted. These events are adjusted in the balance sheet. Non-adjusting events, they are not adjusted. They are not adjusted. What do we do in that case? These are disclosed in report of approving authority. Okay. So maybe in the board of directors report, you can disclose this non-adjusting events. Then there is one more category of event where there can be a question on the going concern assumption of the entity. Say, for example, the entity had a plant. That was the only plant, the largest plant for the company, and that plant got damaged in fire, because of which the existence of the company comes under question. The company may or may not exist in the future, or the company may not be able to operate in the future in the manner it intends to. So whenever there is a question mark on the going concern assumption, then though it may be a non-adjusting event, generally that has to be considered as an adjusting event, and you will have to restate your financial statements. You will have to prepare the financial statements as if the going concern assumption is not being followed, right? So that is the other aspect to this. Now, when do we say that an event is an adjusting event or a non-adjusting event? The key term here is additional evidence for events existing on the balance sheet. Now, what do I mean by that? There is something which is existing on the balance sheet date, and now you are getting an additional information or additional evidence for that. The favorite question from by ICI in these cases is, there is a debtor. The debtor has become, there was doubtfulness that the debtor will pay back the money, and finally, before the financial statements were issued, they realized that the debtor has become bad, or the debtor has gone insolvent. Amount will not be realized. What should be done? So all of us know there has to be an addition, and see, these are the key terms: additional evidence for events existing on the balance sheet date, or the items existing in the balance sheet date, whichever you put it. So items existing on the balance sheet date, whenever you have additional information on that, those will be considered as adjusting event. Otherwise, they will be considered as non-adjusting event. Exception here is if the going concern assumption itself is invalidated, then you will treat them as adjusting events. Are we clear? Now, what are non-adjusting events? fire occurred in the factory, small fire occurred in the factory, or some fire occurred in the factory, some 10%, 20% loss. Those are non-adjusting events. But do we need to disclose them? Yes, they have to be disclosed in the board report or the report of approving authority. This is the crux of adjusting, non-adjusting event as per this standard. Now, do we report all the non-adjusting events? See, after the balance sheet date, till the time the board of director approve the financial statements, there will be lots and lots of events. Do we disclose all the events? You will only disclose material events which require attention of the users of the financial statements, right? So, adjusting events, you will adjust the asset and liability. Other events, you just show the which just needs a disclosure, which are not an adjusting event. These are non-adjusting events. So key terms: balance sheet events providing additional evidence in support of conditions already existing on the balance sheet date. Okay, so this is a favorite question, as I told you, which you get in the thing. Then if the enterprise may cease to be a going concern, then you will have to consider that the going concern assumption is no longer valid. You may have to prepare a financial statement afresh. Okay, then the thing on proposed dividend, very important for you guys to understand. Earlier they had to be provided for. Now you just disclose them. Proposed dividends are just disclosed as required by the statute. Okay, so this is one thing that you can keep in mind, that if there is a proposed dividend, that has to be disclosed. And where do you disclose? Disclose in the report of approving authority, not notes to account. Don't write notes to account. It is in the report of approving authority. Okay. And for material events, what are you disclosing? The nature and estimate of financial effect, or if it cannot be estimated, the fact that it cannot be estimated, that has to be disclosed. Right? So this covers AS4. Let me see if we have any questions from the students. Yeah, you can get our notes from the free resources. Conditions must be existing on the balance sheet. So that is why if there is a fire which happens, then it is a non-adjusting event. If inventory, the value of inventory is reduced after the balance sheet date, you will not consider it to be an adjusting event, because you will take the valuation of inventory as on the financial year end, right? As on 31st March is the valuation of inventory. Subsequent reduction in value of inventory is not an adjusting event. Okay. Debtor is a monetary asset where you may not realize the amount, then that definitely is an adjusting event. Okay, so these are some of the theory questions. You can get it from our notes and revise them. I'll not go through them because all of them are around those critical definitions that we have said. But AS4 specifically, why I'm again and again emphasizing is definition is very, very important. Please write the definition. Please explain why it is adjusting or non-adjusting and give your conclusion. Then you can get your 4 marks or 5 marks of the question. Then accounting standard 5, again simpler concepts. Around those concepts only you will get the questions in the examination. That is your net profit or loss for the period, where we talk about the ordinary items and extraordinary items, then prior period items and changes in accounting policies. These are the 3 aspects which are broadly covered by accounting standard 5. So what are ordinary activities? Ordinary means your day-to-day activities. These are the activities which are undertaken by an enterprise as a part of its business, and such related activities in which the enterprise engages in furtherance incidental to or arising from these activities. Basically, these are the basic day-to-day operating activities of the entity. These are the activities which the enterprise carries out on a regular basis. This is the, you can say the bread and butter activities of the enterprise. These are ordinary activities. Okay. Then what are extraordinary activities? Extraordinary items, there is nothing called extraordinary activities. Extraordinary items are those items which arise other than from ordinary activities of the enterprise, and they are not expected to occur regularly. So these are not from the ordinary activities. These are not from the ordinary activities, and they are not expected to occur regularly. That is when we call these items as extraordinary items. Sometimes extraordinary items are called so because some other standard says that that particular transaction is always treated as an extraordinary item. For example, refund of government grant. Refund of government grant is always an extraordinary item. It may be a small refund, but as per accounting standard 12, refund of government grant is an extraordinary item. So ordinary, your day-to-day activities, your day-to-day operations, buying of goods, selling of goods, manufacturing, customer collection, customer repayment, all of these are ordinary activities. Say for example, one fine day because of fire, there is a huge loss in the factory. Okay, within the balance sheet date, it's not a event occurring after, but within the balance sheet period itself, there is a loss due to fire. Then what would you think? Is it ordinary or extraordinary? That is definitely an extraordinary item because you don't expect it to happen regularly. Similarly, gain on you dispose of fixed assets, those are not expected to happen regularly, and hence they are treated as extraordinary items and disclosed separately. See, the aspect around ordinary and extraordinary is only with respect to disclosure. Extraordinary items have to be disclosed separately on the face of the financial statements, right? Ordinary activities are also disclosed, but they may be clubbed together. But extraordinary items, you have to disclose them separately on the face of the financial statements, right? This is about ordinary and extraordinary. Sometimes what may happen is an ordinary item may be of such a nature that it requires separate disclosure. So it may be an ordinary activity, but it may require a separate disclosure because of the nature or size of that particular item. In that case, you will make a separate disclosure of the ordinary items as well, right? So this is briefly with respect to ordinary and extraordinary. A lot of emphasis in AS5 is given on prior period items and accounting policies. Now, for prior period items, what you need to understand is these are incomes or expenses. These are incomes or expenses which arise in the current period as a result of errors or omissions in the preparation of the financial statements of one or more prior periods. So, let us say you are in the current period 2021, 22, for example. Okay, there is some item which has come into this period, an item of income or expense. Why did it come? Because there was an error or omission in one or more prior period. Meaning to say, let us say in 2020, depreciation was incorrectly computed. Now, if it was incorrectly computed, what would you do? You will give that, you will correct the depreciation impact and you will show it separately in the current period financial statement as a prior period item or prior period expense. Meaning to say, there was an error in the previous period. There was an error in the previous period, and because of that error, we are now correcting that depreciation impact in the current financial statement. Current financial statement carries that additional depreciation. That is because of a prior period item. That's what it is called, a prior period item or prior period expenses. Okay. Then why should it come? Because of an error or omission. You forgot to charge depreciation. You forgot to charge depreciation in one of those assets. You have omitted, or there is an error which you have committed. Maybe some Excel formula error while copying from top row to the bottom row. You have missed that formula. You have done a cut instead of doing a copy. Anything can happen, but there was an error. So I have seen some errors like the carrying amount of assets have become negative because depreciation was continued to be charged even when the residual value was even when the carrying amount of that asset had become zero. Because Excel, right, thousands of assets, you simply do a copy paste, there can be an error. If it is an error, then in the next period you will have to disclose it as a prior period expense. That is one thing you need to keep in mind. Now, say for example, for the same asset, the estimated useful life was considered to be 5 years, and now in this period we have reassessed it as 6 years. Is it an error? No, it is not an error. Is it an omission? No, it is not an omission. It is a change in accounting estimate. So you have to distinguish between errors, omissions, and changes in accounting estimates. If it is a change in accounting estimate, it is not considered to be a prior period item. Or if it is a change in accounting policy, even then that is not considered as a prior period item. You change your accounting policy valuing of inventory from FIFO to weighted average. Is it an error? No. Is it an omission? No. Is it a change in estimate? No. It is a change in accounting policy. So changes in accounting policies are also not prior period items. Now, these are the areas which are tested in the examination. They will give you a scenario and say, is this a prior period item? Or is this a change in accounting policy? You have to understand that carefully and give your answers accordingly. Then, what are accounting policies? We have learned in AS1 also. Specific accounting principles applied in preparation and presentation of financial statements. Example could be your inventory, valuation methods. Depreciation methods and all of those, they are considered to be, whenever you do a change, as per accounting standard 10, they have been now considered to be a change in accounting estimate. That is because it has been brought in line with Ind AS 16. That is the reason why now, earlier it was a change in accounting policy. Now it is a change in accounting estimate. Okay. So what all we discussed so far? While preparing the financial statement, you will disclose ordinary activities, extraordinary activities separately, prior period items separately, accounting estimates separately, and changes in accounting policies separately. So a specific focus again on some exceptional items. Though certain items may not be extraordinary items, the nature and amount of such items may be relevant to the users of financial statements, understanding the financial position and performance of the enterprise, and hence they are disclosed separately. They are disclosed separately. You dispose of a division altogether, right? So that may be an extraordinary item, but you have sold a lot of, you have sold a fixed assets. Now these fixed assets, you will disclose them separately. Examples for ordinary activities which require separate disclosure. So these are some of the activities which may require a separate disclosure, though they are, ordinary activities. Okay. Please discuss one or two illustrations. Sure, I will include that. And we discussed extraordinary items are distinct from ordinary activities and therefore are not expected to reoccur frequently. And that is what it has to be disclosed separately. Now, see, some items may be extraordinary, some may be ordinary, some may be exceptional. You cannot have a hard and fast rule. Based on the circumstances of the case, based on the facts of the case, you have to take a decision, right? Yeah, so another thing you can keep in mind is if there are some arrears which are paid to the worker, so there were some settlements going on and in this year you pay arrears of the past year, those are not prior period items. Changes in accounting estimate is a normal state of a thing, so I'm just exclude that. Then changes in accounting policies. Again, another favorite question, which gets tested quite often. When can an entity change its accounting policy? So a change in accounting policy is permitted if it is necessary by provisions of statute, that is law, or for compliance with an accounting standard. So if there is an accounting standard which requires you to change the accounting policy, then you can change it. If a law requires you to change the accounting policy, then you can change it. Or if it results in a more appropriate presentation or a better presentation of the financial statement, then you can change the accounting policy. And whenever there is a change in accounting policy, you need to disclose the impact of the change. If the impact of the change is in current period, what is the impact of change? So an example could be, during the current period, the entity changed the method of valuation of inventory from FIFO method to weighted average method. Had the entity not changed its accounting policy, then inventory would have been overstated by so much and P&L would have, the profit for the year would have been excess by so much. So you have to give a disclosure like this. What is the change in accounting policy? What is the impact of the change in accounting policy? Right. So both the things have to be disclosed. So any change that materially on the financial position has an impact, performance of the cash flow should be disclosed such that the adjustment resulting from such a change is clearly brought out, right? That is what is required to be changed. And what should be disclosed? You should disclose what is the impact of the change and to which periods will the impact of change apply to. For example, does it apply only in this period, or does it apply in this period and also in the future period? That has to be disclosed. So some quick explanations. Methods of change, depreciation, changes in estimated useful life and all of that are accounted for as change in accounting estimate. Change in inventory valuation method is a change in accounting policy. Wrong calculation of depreciation, as we discussed, is a prior period item. Attachment of a property by a court or loss of an asset in a natural calamity is an extraordinary item. Wrong counting of a closing stock is a prior period item, because here there is an error. Changes in provision for doubtful debt is a change in accounting estimate, right? So this will help you to relate what is change in accounting policy, what is change in accounting estimate, what is a prior period item, what is an extraordinary item, and what are ordinary items. So based on the request from one of you, let me just take a couple of questions. So here there is one question. X Company Limited signed an agreement with its employees union for revision of wages in June of year 12. Okay. The wage revision is with retrospective effect from 2008. Revision was signed in 12 and it is having a retrospective effect. Arrear up to 31st March of 12 amounts to 80 lakhs. Arrear wages for the period 1/4/12 to 30th June amounts to 7 lakhs. Decide whether separate disclosure of arrear of wages is required. Now, what is this? This is a change in accounting estimate? No. Is this a change in accounting policy? No. There was some settlement which has happened with the employees. It's not also a prior period item. It's also not a prior period item, right? So, in this case, what has happened? The arrears are finalized in June 12. Arrears have finalized in June 12. Okay. So, it is not an error. It is not an omission, right? And wages that you pay to the employees, these are ordinary activities. But some ordinary activities may be of a may have a significance, because of which you may require a separate disclosure. They may be exceptional items. You are paying 5 years of wages in a single year. In that case, definitely there is something which is significant. There is something which is material, and hence a separate disclosure may be required. And also note, whatever is the amount from 1st April to 30th of June, these are ordinary activities. These are the expenses pertaining to current period only. Okay. Yes, and other thing is, if you have made certain provision for expenses for some amount, let's say 7 lakhs here, but actual expenses are 9 lakhs, then whether the 2 lakh is a prior period item, then in such a case you have to define what is a prior period item, and you have to explain why this is not a prior period item and why this is a change in accounting estimate. And because it's a change in accounting estimate, it is an item of ordinary. It is item arising from ordinary activities. There is no separate disclosures which are required. Right? So I think, yeah, these are the kinds of questions you would get. And maybe towards the end of the session, we'll take up, once we finish the session, the next session, we'll definitely take up more questions. Difference between extraordinary and exceptional. Okay, so when we talk about extraordinary items, these are not arising from ordinary activities. Exceptional means ordinary activities which may have a material impact, which requires a separate disclosure, which is of such amount or which is of such nature that requires a separate disclosure. Like we talked about the wages arrears, right? Those are from ordinary activities, but they are of a nature which requires separate disclosures. These are called exceptional items, right? Now, as far as the other question that we discussed, the difference of 2 lakhs in estimate, if that is considered to be material and significant, then you may require to disclose it separately. But you can make an assumption either side and you can give the answer. Okay, any more questions? Let me just go through. Yeah, okay. So this is done. Now the next standard, accounting standard 7, construction contracts. One standard where students make a lot of computational or silly mistakes, I should say. Okay. So what happens is, in this standard specifically, there is a lot of technical jargon involved, but if you try to break it out, it is very simple. It is very simple. This standard revolves around your the matching concept and obviously prudence. If you apply these two principles to the standard without going into the technicalities of the standard, as a normal accounting, accounting professional also, you will be able to do the treatment as given by this standard. Okay. Just to give you a perspective, let us say, so A7 applies to construction contracts. Right? Now, say for example, you have taken up a contract, you are a builder and you have taken up a contract. There are 2 years, 2020 and 2021. Okay. Now, in 2020, you have taken up a contract and you are incurring certain costs. Let us say you are expecting that you will incur cost of 80 crores, and next period you have incurred a cost of, let us say, 75 crores, for example. Right? And by performing this contract, your revenue that you will get at the end of whatever is the time schedule and all of that, you may get in installments and all of that. 80 plus 75 is 155. Let us say 200 is the revenue. Now, if I ask you what is the total profit from this construction contract, total, not year wise, what is the total profit? Total profit is, you will say total cost is 80 plus 75, 155. Total revenue is 200. So profit is 200 minus 155. 45 is the profit. Correct? 45 is the profit. Now, 45 is the profit that all of us know. What is the challenge? How much should be allocated to 2020? How much should be allocated to 2021? That is the challenge. Or say, for example, by the end of year 20, you have incurred 80 lakhs and you expect that you will incur 75 lakhs in the next period, and the revenue is only 150. There is a loss of 5. Right? Now here you will apply prudence. If the estimated result or outcome of the contract is a loss, you will recognize that loss immediately. That is the first thing. In the earlier case, you will see how much is the cost incurred in 2020 as compared to the total cost. So you will say what is the percentage completion. Okay, percentage completion is 80 divided by 155. That comes to 51.6%. Let me just change it to percentage. 52. I'll increase the size. Just a second. Yeah, 51.61, and 75 divided by 155 is 48.39%. Now, the standard requires, the underlying principle of the standard under matching concept is the revenue should be matched with the cost. So if you have incurred cost of 80, which represents 51.61%, your revenue in this period should be 200 total expected revenue multiplied by percentage completion, that is 103.22, and in the next period it should be 48.39% multiplied by 200, which is 96.77. This is the overall crux of the standard. I'll come to amount due from customers, amount paid to customers, work certified, work not certified. We'll take one example on that, but this is the crux of the standard. Now, revenue minus cost is your profit. 23.23 is the profit here, 21.77 is the profit here. This is how it has to be recognized. If there is any loss which is estimated, that has to be recognized immediately. You will not apply proportion in that case. Otherwise, you will use percentage completion method to apportion the cost between each year of the particular contract, right? But obviously you have to ensure that the outcome of the contract should be certain. It should not be that you have not yet started the contract itself, simply you are just booking the expenses. That those things are not allowed. You have to check whether there is collectibility criteria. When we go to AS9, we'll understand that whether the customer will pay the amount to you, whether you can measure the cost reliability. That is also very important. Just that there is a cost being incurred, but if you are not able to measure the cost of the contract, it will be difficult for you to apply the principles of percentage completion. But as far as the understanding is concerned, this is the underlying principle governing this particular standard. And if you see, most of the questions in the examinations from AS7 is with reference to some cost incurred, some work certified, some work not certified, and then some amount received. What is the percentage completion? What is the P&L amount? And those related aspects, right? So what I will do is, for AS7 specifically, I'll take one problem Okay, so there's nothing coming up now. No questions. Okay, fine. I'll take up one problem and maybe one examination problem, two problems to help you not masterfully, but you will be able to cover 80-85% of the standard once you understand those two things. Okay, so I'll not go into technical jargons here because there'll be too much of things here. But yes, some specific aspects that I want to highlight here is there could be a fixed price contract where there is a fixed price fixed in the contract, or there could be a cost plus contract where you have defined the cost. Over and above the cost, you will get some margin, right? So let us say 100 is the cost, 20% margin, 120 will be the revenue. So there could be a fixed price contract and there could be a cost plus contract. And what are included in construction contract? Your normal accounting principles, all the costs, direct material, direct labor, direct expenses, overhead for the particular construction activity, specific cost for the particular customer, all of those are included. Interest also, if permitted by AS 16, are included, right? Then sometimes there may be a variation in the construction contract. Say for example, I wanted to construct a 2-floor building. Then I changed my mind and I said, okay, I don't want a 2-floor building. I want, let us say, 2.5-floor building. I want to add another half floor on the top of the second floor. Half floor means part of the building, right? Now there is a variation. Now, because there is a variation, there may be an increase in contract revenue or there may be a reduction in contract revenue, but that is subject to the condition that we have to check the probability that the customer will approve the variation and the amount of revenue arising from the variation, and you can measure the revenue reliably. So just because I have changed, or the customer said I want the change and the construction contractor has changed it, but still you have to ensure that the customer will pay. There is a probability that the customer will pay and you can measure the revenue reliably, and in such cases you can add this to the contract revenue. Similarly, sometimes you may have a claim, because of the steel prices going up, suddenly the contractor feels that the project is no longer viable, but now because he has taken the contract, he has to execute it. He may go and negotiate with the customer saying that, see, the steel prices are going up, please give me that additional amount because otherwise I'll not be able to work properly. All of those things contractor may negotiate. If the customer approves, very good enough, you can include that as a part of your revenue. Sometimes there may be incentive payments. Let us say I am a contractor, I got a contract to build a bridge, and the contract says if I build the bridge in 1 year's time, I'll get some amount as incentive. So I will get extra workforce and extra machineries and all of those things. I'll complete the bridge well in time and I'll get the incentive. So again, for incentive, you have to see that whether the contract is in an advanced stage, that it will be able to meet the performance standard. So you can't say that today I'll start the contract and today itself I've got extra workers and extra machinery, and today itself I want to recognize this incentive benefit. I cannot do that. It has to be in sufficient advanced stage. Let us say all the pillars have been poured, slabs have been poured, only small few parts are left over, which can be completed in the given 1 year period of time. In that case, I can recognize the incentive. Otherwise, I cannot recognize. And obviously, it has to be measured reliably. You will see in most of the standards, you must be able to measure the cost reliably or revenue reliably. You have to ensure the collectability. You have to ensure that the cost can be measured reliably. Even here, you will be able to measure the incentive reliably. Only then you can recognize the incentive payment. Less likely that you will be getting questions on these lines. You may get, I'm not saying no, but more often than not, you get questions on numericals. Okay, so let me just take one question quickly. This is a simple question, but still will cover most of the concepts that we are expected to learn in this particular standard. And then I'll take up one question from the exam paper, which will help you understand the linkages between various concepts given in this standard, right? Let me check anything. Okay. PRZ and Sons are heavy engineering contractors. Okay, fine. From the records of the company, the following data is available pertaining to the year ended 31st March of 17. And again, let me tell you, if you are able to understand this question, if you are able to solve this problem, most of the questions would be on similar lines, right? Using this data and applying relevant accounting standard, you are required to compute the amount of P&L for 31st of March Arrive at the contract work in progress at the end of financial year 16-17. Determine the amount of revenue to be recognized out of the total contract value. Work out the amount due to or due from the customers. And list down the relevant disclosures as per the relevant accounting standard. So what is there? There is total contract price. Total contract price is 2,400. This is the total revenue that the construction contractor will get over the life of the contract. Then work certified and work uncertified. 1250 and 250. What are these? These two are the cost incurred till date. Okay. Then estimated further cost to completion. Estimated cost to be incurred in the future is 1750. Now, if you see total cost, total estimated cost is 1750 plus 250, 2000 plus 1250, 3250. Then stage wise payments received. So payments received from customers. $1,100. Payments in progress. This also will be received. These payments will also be received. So customers has given, or we are about to receive, or we have received a check or something like that. Right now, correct. So this is it. Now, what are we asked in the question? We are asked to compute the amount of profit or loss for the year ended 31st of March of 17. Then what would that be? If you see here, total expected contract costs are 1250 plus 250 plus 1750. 3250 is the total cost. Total revenue expected is 2,400. Now, the moment your contract cost exceed the revenue, then you have to recognize the loss. So 3250 minus 2,400, this is the expected loss, right? That is the expected loss. Okay. Then it says arrive at the contract work in progress. Contract work in progress is your 1250 plus 250, 1500 is the contract work in progress. Correct. Then determine the amount of revenue to be recognized out of the total contract value. So what will be the revenue? Revenue to be recognized is based on percentage completion. Okay. What is the percentage completion? Total cost incurred is 1250 plus 250, 1500. And total expected cost is 3250. So 1500 is the numerator, 3250 is the denominator. If you do this, you get 1500 divided by 3250, 46.15%. 46.15%. This is the percentage completion. So revenue to be recognized will be 46.15% of 2,400, which comes to 1107.69. Right? Then amount due to or due from the customers at the year end. Now, this is one important formula where students get to forget. They tend to forget how to arrive at this formula. Very simple. There is a underlying logic behind this formula which you need to understand. What is the underlying logic? Say, whenever you sell some goods to the customer, what happens? How much do you charge from the customer? He will say sale value is equal to cost plus profit. Correct? Simple. Sale value is the cost plus profit. If it is loss, sale value will be cost minus loss. Sale value will be cost plus profit or cost minus loss, whatever way you want to put it, right? Now, if the customer has paid you, let us say, so cost plus profit, for example, cost is 100 plus profit is 20, 120, and customer has already paid you 80. This we call it as progress billing. Then how much is to be received from the customer? 120 minus 80, you have to receive 40 from the customer, right? This is amount due from the customer. Very simple. The total cost plus profit minus loss minus any progress billing will give you amount due from the customer. But let us say the customer, instead of paying 80, has paid 140. Then you have received excess amount from the customer. Now this is amount payable to the customer. Now you may think, why will the customer pay extra? See, I'm not talking about sale of a single good. We are talking about a contract, construction contract, where the customer has paid us maybe advance amounts. The customer has paid us advance amounts and we are incurring the cost subsequently. That is possible, right? So if it is a negative number, then you will reduce, you will call it as payable. If it is a positive number, you will show it as receivable, right? So just to, this cost incurred plus profits minus progress payments received minus losses. So in our case, what is the cost incurred? What is the cost incurred? Cost incurred is 1500. Is there any profit? No profit. There is a loss minus loss of 850 minus progress billings of 1100 and 300. You get 750. So because it is negative number, this becomes amount payable. This is the simple underlying concept as far as accounting standard 7 is concerned. We have covered percentage completion, we have covered revenue recognition, we have arrived at the loss from the contract, and we have arrived at the amount payable from the, or amount payable to the customer, right? So just a second, let me just open the question paper, one recent question paper. So again, now so similar question. Now don't think that because it was tested in July, will it be again tested in November? It may be tested. We do not know. Okay. Following data is provided by a company. Contract price. This is the revenue. Material issued 21 lakhs, out of which material costing 4 lakhs are still lying unused. Meaning to say, you have given material or you have issued material of 21 lakhs. 4 lakhs is still unused, which means how much is the material used? The material used is 17 lakhs. Keep your head cool. If you keep your head cool, you'll be able to get this information easily. Then labor expenses for workers engaged at site, 16 lakhs, out of which 1 lakh is unpaid. We will follow accrual basis. So 16 lakhs will be the expenditure. Specific contract cost, 5 lakhs. So specific to the contract, there is a cost incurred of 5 lakhs. Subcontract cost for work executed, 7 lakhs. Now what does this mean? Sorry. Say you have taken a contract, you have given it to somebody on a subcontract basis. So the cost incurred there is 7 lakhs. And on top of it, there is advance which is paid to subcontractor 4 lakhs. Is advance relevant to us? No. We'll again follow the accrual basis of accounting, right? And further cost estimated to be incurred to complete the contract is 35 lakhs. You are required to compute percentage of completion. So we'll have to compute what is the total cost incurred. That is 21 minus 4, 17. 17 plus 16, 33, 33 plus 5, 38, 38 plus 7, 45, right? 45 is the contract cost incurred, 35 is the contract cost to be incurred. So 45 plus 35, total becomes 80, right? So 45 divided by 80, 56 is the percentage completion. Revenue to be recognized is 85 multiplied by 56%, 47 lakhs. And cost 45 lakhs. Very simple, right? Simple. Any questions on this? Okay. So no questions. So we can continue further. Just from the standard, understand how to compute the percentage completion understand how to calculate the amount due from the, or due to customer. If there are any losses foreseeable, that will be recognized immediately, and what will be the amount of profit or loss will be dependent on how much is the revenue and cost recognized in the under the particular contract. And see, the only confusion point could be work certified, work uncertified, and all of those things. These are generally given to you at cost. They'll mention you, what is, if they don't mention also, assume that those are at cost. Work certified means work completed, and maybe the customer has certified that, okay, this work is completed, or some representative of the customer has satisfied. So that is one thing you can, keep in mind. And work uncertified means you have spent the money, but the other party has not yet certified. That is what is work uncertified. So certified plus uncertified is the total cost that has been incurred, and to that add the future estimated cost. If that exceeds the revenue, then you will recognize a loss. Okay. Right. So now we'll move to the next standard, which is on revenue recognition. Revenue recognition accounting standard 9. Very, very important. Not just only for the exam purpose, but also from practical standpoint of view. Now here also, the underlying principle of revenue recognition is what we must be clear about. What is revenue? Revenue is inflow of cash, receivables, or other consideration from critical things that are sale of goods, rendering of services, and from use of others by the resources and the resources yielding interest, royalties, and dividends. So these are all classified as revenue. So if you sell goods and if you get amount from the customers, that is defined as revenue. If you have provided services, you get some money from the customers, those are considered to be revenue. If the other enterprises are using, if you have, let us say you're a banking company, you have lent money, you get interest, that is revenue. If you have invested somewhere, you get dividends, that also is revenue. Right. Now, once we have defined or understood revenue, we have to see when should we recognize revenue for different scenarios, and what all items should be excluded when we calculate revenue. So revenue means let's say there is a sale of fixed asset. There is a sale of fixed asset and there are some gain on sale of fixed asset. Is that a revenue? That is not revenue. That is not considered to be revenue. You increase the value of, not increase the value. You will, let's say you have reduced the value of inventory. Now, next period, the, NRV increases and now you have increased the value of inventory. Can that increase be considered as revenue? No, it cannot be considered. If you only sell those goods, if you provide them some services, the consideration that you get in return, that is what is considered as revenue. Okay. Now, revenue, you have to see first, whenever you have to recognize revenue, you have to see whether, let's say there is, sale of goods. Have the, in substance, the risk and rewards have been transferred to the buyer. Then you can recognize revenue from sale of goods. So basically, the property has transferred. Sometimes formalities are pending, but in essence, has the property been transferred? Then you will recognize the revenue from sale of goods. When it is from sale of services or provision of services, you will see whether whether the services have been completed. Based on that, you will recognize revenue. It can be on the basis of percentage completion method, or it can be on the basis of full service completion method. Either of those two things can be done, right? So, when we say revenue recognition, we mean you are accounting for those revenue in the books, right? Here you have to ask questions like, are you able to measure? Are you able to measure the revenue reliably? Now you may say, how do we know, or what can be situations where we are not able to measure the revenue reliably? Maybe those are dependent on some, cost plus some percentage of cost basis. You're providing services and they say, okay, whatever cost you incur, and we'll add some more percentage on that cost, and that becomes your revenue. And say, for example, you are not yet in a position to measure the cost reliably. Some small part of services have been given, then you will not be able to measure the revenue reliably. So you have to check whether you are able to measure the revenue. Then, will you be in a position to collect the revenue from the customer? You have sold the goods, but the moment, at the time of sale of goods itself, you had a doubt whether you'll get the money back or not. Now you may say, why will I sell to a customer if I don't get the money? May be possible that after we have dispatched the goods, it was on pay on delivery basis, the customer did not want to pay. That could be one possibility. Or bank has given, let us say, loan to a customer which is about to be default, which is in a default mode, but still they have given some loans so that they may survive and they may be able to repay back. They have just taken some risk, and their collectibility may not be certain, right? So you have to check whether collectibility is certain or not. Or you have given loan for one period, you have got the interest, for the next period you have not got the interest. So there also again you need to check collectibility, right? So if you are able to measure revenue, you have to check that condition. Then you have to check whether you are able to collect the revenue. The probability of collection is also very, very important. Now, only when these two conditions are satisfied, you will be able to recognize revenue. You are able to recognize. But okay, I'm not able to measure. You have to defer it to the time, till the time you will be able to measure. I'm not sure of the collectibility. Then when the collectibility becomes certain, or when the collectibility becomes probable, that is when you will recognize the revenue. Now, I've sold the goods. I have recognized the revenue. And after 1 month, I realize that collectibility is not possible. Then what do? That point of time, I create something called as provision for bad and doubtful debts. I will not reverse the revenue. So future collectibility issues will result in a provision, for losses. But at the time of the transaction, or in the process of the transaction, if collectibility becomes doubtful, then you will not recognize revenue. This will be deferred till the time collectibility becomes probable. Okay, so if these two conditions, measurability and collectibility, is satisfied, recognize; otherwise, do not recognize. So as I said, if consideration is not measurable, then you will postpone recognition. If collectibility is uncertain, postpone recognition. Once you postpone, then in whichever financial year there comes the certainty, in that period you will recognize the revenue. And this we spoke about, you will make a provision if the answer later. Okay, now we'll come to specific aspects of sale of goods, services, and other aspects relating dividend, royalties, interest, and all those things. But for sale of goods, there has to be transfer of property. That is, the seller has either transferred the property, or all significant risk and rewards of ownership have been transferred to the buyer. For example, just for illustrative purpose, let us say you have purchased a two-wheeler. You have purchased a two-wheeler from the showroom. Registration is pending. But two-wheeler, the showroom has sold the two-wheeler to you. Invoice has been generated. You have made the payment. Road tax is also paid. Registration is pending. Now, do you think the sale has happened? Yes, the sale has happened. The property has been transferred. Only a formality of registration is pending, right? So, because the formality of registration is pending, that does not mean that the property or the risk and rewards have not been transferred. So once the risk and rewards have been transferred to the buyer, you will recognize the revenue. Okay, and the control over the goods have been passed on to the buyer, meaning to say the seller has no control over the goods. So if I have sold the goods, the customer has taken away the goods, it is in his control, then I can recognize the sale, right? This is similar to the a lot of concepts that I have learned in Sale of Goods Act as well. Similar concepts have been applied here. Property have been transferred, or risk and rewards of ownership have been transferred, and control of the goods lies with the buyer. Now, the kind of question sometimes the twist and give it to you is: advance have been received, property has been sold, everything has happened, sale date is pending, which has happened in the next financial year. Now, in that case, substantially all the things which are required for transfer of property has happened, and then in substance, applying the concept of substance over form, you can recognize the revenue. This is one kind of question which generally gets tested in the examination, right? So generally, property, when it is transferred, then you can recognize the sale of the particular goods. Okay, when it is services, you either use completed service method or proportionate completion method. Proportionate completion is similar to the contract thing that we have seen. Completed service method means, let's say you want to install a AC, right? Now, once the AC installation is complete, the service is completed, and hence you can recognize the revenue. Then interest is recognized on time proportion basis using accrual concept. Okay. Royalties, based on the agreement, you will recognize that. Dividend are recognized when the owner's right to receive the payment is established. So once the dividend is declared, and then you are the shareholder on the record date, you are entitled to receive the dividend, then you can recognize the revenue. of the dividends. See any specific question? I discussed one question with work in progress amount due from customer. What you can do is you can refer to our notes, or you can pick up one of the past exam questions, and if you have any doubt, you can ask us in the forum. Okay. You just remember that formula. You apply that formula in one of the past exam questions, you'll be able to handle that. Rama Sesha Gopal. And if you are still having a doubt, you can please post it at our forum. We'll be able to help you out. Sir, if you find out that the cost exceeds the revenue, should we recognize the entire loss? Entire loss, no proportionate. Prudence concept means the moment you see there is a loss, recognize the entire loss. Not that I'll defer the loss over 3 years or 4 years period. No. Whatever is the loss, total loss will be recognized in the same period. Similar to the manner that 750 of loss, right? In the same manner what we have seen in the illustration. Okay. Then let us look at few specific examples from revenue, so that in examination, if a question appears from these, examples, these kind of situations, you are able to conclude. Now, whenever we are talking about revenue related questions, you must be in a position to define or explain when do we recognize revenue. In case of goods, how do we recognize? In case of services, how do we recognize? And whether those conditions have been fulfilled, and hence you are recognizing that revenue. Okay, yeah. So buyer requests delivery but takes title and accepts billing. Okay, so buyer requests deferred delivery. It's not a buyer request delivery. Buyer wants delayed delivery. So even if delivery is not made but billing has happened and title has been transferred, then you will recognize the revenue. Goods sold subject to installation and inspection. Now, for example, I have ordered some item. Let's say I've ordered an air conditioner. Okay, and my condition to the seller is that, Mr. Seller, you have to install that AC in my premises. Only after successful installation, I accept the goods on my name, or I'll accept that I have purchased the goods, and then I'll make the payment. Till the time it is installed to my satisfaction, I am not accepting that you have sold the goods to me. In that case, only when I accept the goods, the installation, then the seller can recognize the sale. Okay. Sale on approval. Once the customer approves. So, a lot of time it happens, right? You buy goods from Amazon and you have 10-day, return period. Till the time of that 10-day return period, you will not be able to recognize revenue, because the customer has right to return. Or they may recognize the revenue and make a provision for returns that will happen post the balance sheet date. That's also possible, right? So you have to see whether there is a sale on approval. So if approval is given, then you'll recognize the sale. Or let us say time has elapsed, 10-day period is over and you have not heard back. That means customer has accepted. Okay. Then if there are guaranteed sales, or if there are sales with warranty, then you will recognize the full sales and make an appropriate provision for warranties based on past experience. Then consignment sale. Consignment sale is when the consignee sells the goods, because consignee is your agent. So transferring the goods to the agent is not a sale. Only when the consignee sells it to a third party, you recognize the sale. Cash on delivery. Goods which are sold on cash on delivery basis. Only when you receive the cash, you will recognize the revenue. Series of installment payments by buyer leading to delivery only when the final installment is paid. So only when the final installment is paid, you will deliver, property is transferred, only then you can recognize the revenue. Hire purchase cases, you will follow the principles what you have learned in hire purchase accounting, right? Though the title gets transferred later, you can recognize the sale upfront. Right, then all of these are similar things. Installment, again, installment sales will be recognized immediately. For advertising agencies, if there is a media commission. So let us say we run advertisements and we have an agency. We pay some commission to the agency based on the ads placed in the media. Okay, so based on the number of ads being placed, or based on the amounts spent on the medias for advertisement, you give the commission to the media agency. So for that media agency, based on how we spend the amount on advertisements, they can recognize their commission on accrual basis, right? Then these are all straightforward ones, nothing significant here. Yeah, so let's look at this question. Arjun Limited sold its farm equipment through its dealer. One of the conditions at the time of sale is that payment of consideration is in 14 days, and in the event of delay, interest is payable at 15% per annum. The company has not realized interest from dealers in the past. However, for the year ended 31st March, it wants to recognize interest due on the balances due from the dealers. The amount is ascertained at 9 lakhs. Decide whether the income by way of interest is eligible for recognition. Now, generally, you would say if there is a condition of sale that interest is payable after 14 days, the entity can recognize interest. But in the past, the entity has not been able to collect interest, right? Or they have not realized. So the past experience shows that the interest is not realized, interest is not collected, which means the entity may not collect in the future unless they demonstrate that they will be collecting it. You will presume that the entity will not collect in the future, and hence you will not recognize the interest. If you collect it actually, then you can recognize. The board of directors of X Limited decided that on 31st of March to increase the sale price of certain goods retrospective from 1st of Jan. As a result of this decision, the company has to receive 5 lakh from its customer, but the company's accountant is reluctant to make up his mind. Now you are going and increasing the price on a retrospective basis. Do you think customers will pay to you? Do you think customers will pay to you the increased amount? They will not, right? Today, as students of Indigo Learn, if I say we have increased the prices of our existing courses from with effect from 1st of July of 2021, please pay us extra amount. Will you guys pay? You will not pay, right? So can I recognize revenue? We cannot recognize revenue in that case, right? So similar things of this here. This is one question which keeps on appearing. Okay, A Limited entered into a contract with B Limited to dispatch goods valuing 25,000 every month for 4 months upon receipt of entire payment. Okay, B Limited accordingly made a payment of rupees 1 lakh, and A Limited started dispatching the goods. In the third month, due to a natural calamity, B Limited asked A Limited to not dispatch goods until further notice. So please understand, A Limited has entered into a contract with B to dispatch. So A is dispatching, and what B said in the third month, don't dispatch. A Limited is holding the entire goods worth rupees 50,000 ready for dispatch. A Limited accounted 50,000 as sales and transferred the balance to advance received against sales. Comment on the treatment of the balance amount with reference to the provisions of accounting standard. Now here, what if you say the sale is for 1 lakh, entire amount has been received, the contract has been entered into, and goods have been made ready, goods are ready for dispatch. At the request of buyer, we are not dispatching. So we can still recognize the sale for the entire amount because buyer has requested a delay in delivery. So from our side, our activity is done, money is received, the title has been transferred, just that the delivery is delayed, and hence still then we can recognize the revenue from sale of such goods. Okay, so we'll have these questions similar in lines, whatever we have been discussing so far. Let me see if any questions. Yeah, you will be able to go back and see it again. So that is perfectly fine, not an issue. Okay. Right. So we'll call it off the session here today. We have covered till accounting standard 9, 4, 5, 7, and 9, and we'll try to cover up 17, 19, 20, 21, 22. Sorry, not 21. Okay, 20, 22, 26, and 29 in sessions coming up next. For these standards, if you have any question, you can let me know. I'll be happy to answer them. Or if there is any other from the standards. See, now on AS4, again, there are these 4 questions for 5 marks. Again, keeping in view the provision of AS4, each case you have to decide, right? So look at the case, apply the principle, and try to get a conclusion, right? I will cover AS 18 also. That also will be. Okay, so under AS5, like you have to disclose extraordinary, items. Extraordinary items have to be disclosed. Changes in accounting policies have to be disclosed. Whenever there is a change in policy, what is the amount of impact of change in the current period, previous period? That's as per AS1 also. Right, that needs to be disclosed. If you cannot quantify the amount, that has to be disclosed. Okay, so no other questions. I'll call it a day here, and we'll again catch up on Monday at 3 p.m. again, and we'll be covering up the next 3 to 4 standards. Then again, maybe on Wednesday we'll cover up the balance standards if required. Right. Thanks a lot for your time. I hope you guys are preparing well. Please focus on your preparation and stay cool, stay calm. Right. Thanks a lot.